Welcome back to Investing Talk Podcast.
Today we're looking at Inspire Veterinary Partners.
And this is a really interesting one. A story defined by some extreme corporate risk, a lot of volatility, and a critical deadline that's coming up very, very fast.
It really is.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it.
Usually, we start with the fundamentals, revenue, growth, that sort of thing.
All right, the basics.
But here, the whole story, the whole investment thesis, it's just completely dominated by these external factors. We're talking about a company that is, it is right on the edge of a regulatory cliff.
And that cliff is the Nasdaq delisting issue. I think that's the single most important thing for anyone looking at this stock right now.
Absolutely.
They got a formal notice, what was it, November 13th, for failing the minimum bid price requirement.
Right, the minimum bid price. Trading below $1 for too long, that part's common.
We see that all the time.
All the time. But what is absolutely not common here is the severity of what comes next.
Right.
See, most companies, they get 180 days, a grace period, to fix their share price.
A compliance period.
Yeah. Exactly. Inspire Veterinary Partners.
Yeah.
They are not eligible for that.
And that's the real crisis, that ineligibility. So walk us through why. Why did they lose that right to a grace period?
It all boils down to their history, a history of, let's say, aggressive maneuvers. The rules are pretty clear. If a company has done multiple reverse stock splits over the last 2 years, and the cumulative ratio is at least 250 to 1.
250 to 1, wow.
Yes, then you're disqualified from that standard compliance timeline. It basically says you've used extreme measures to stay listed before, again and again, and now you're out of chances.
So that shrinks the timeline from months down to days.
Literally days. The time frame it's shockingly short. They had to file an appeal of the decision by November 20th.
Which we assume they did.
You have to assume they did, yes. So the next step is a formal hearing before the Nasdaq appeals panel. And the outcome of that is expected, almost immediately, probably before the end of November.
And if they don't win that appeal?
Then they face suspension and delisting by November 24, 2025. For the market, for any investor, that hearing is the only thing that matters in the short term.
It sounds like a pure binary outcome is just around the corner. But okay, let's just, for a second, let's set aside this huge regulatory pressure.
If we can.
If we can. Because there's this really bizarre contrast here, isn't there? The operational story seems surprisingly resilient, almost buried under all this corporate chaos.
That tension is what makes this whole situation so compelling. You're right. If you just ignore the stock price and all the governance issues for a minute, the underlying business is showing remarkable health.
They have that veterinary clinic roll-up strategy, right? And it seems like the actual clinics are doing great.
They're thriving.
So let's look at that operational bright spot, the Q3 2025 numbers. What do they tell us?
The top-line numbers were really robust. Overall revenue was up 7% year over year.
Which is solid.
It's very solid. But the real key, the metric that tells you about the health of the business, is comparable clinic revenues. Same-store sales.
And more of those.
They were up 9.2%.
9.2%. That is way above the industry average, even with inflation and pet services.
It is. It really validates their core model. They're acquiring these practices, integrating them, and they're benefiting from this enduring demand for pet healthcare.
It shows that their execution at the local clinic level is working. The actual customers, the pet owners, they're sticking around. They're happy, regardless of what's happening on Wall Street.
Exactly. Sustaining near double-digit same-store sales, that's a sign of operational excellence. It points to strong pricing power and just effective management on the ground.
But, operational success is one thing. Financial stability is another, especially when you're still posting a net loss. You said the bottom line improved.
It did, and significantly. Net losses declined by 27% compared to the year before.
Okay, that's a crucial piece of progress.
It is. It suggests they're getting better operating leverage, better cost discipline. In a high fixed cost business like this, with staff, equipment, rent, getting control of your margins is essential for ever reaching profitability.
Okay, but let's be critical here. Improving losses by 27% is good. But improving from a really bad number is still, it's still a loss.
That's the pivotal question, yes.
What's their cash burn looking like? How much runway do they actually have if they lose this Nasdaq appeal and can't get new financing?
And that's what the market is trying to figure out right now. The runway is extremely short. The 27% improvement is a great sign, but it doesn't stop the clock.
So if they get delisted, raising more money becomes much, much harder.
Almost impossible through traditional means. You lose that institutional visibility. So the operational health is basically on a ticking clock. The business is good, but the corporate vehicle is starving for cash and about to be evicted.
And that tension-healthy clinics, dying corporation, that's what's causing the insane volatility in the stock price.
Completely. I mean, the delisting notice just triggered a brutal sell-off. The stock cratered over 60% right after the announcement.
And last we checked, it was hovering around, what, 12 cents?
Around 12 cents a share, yeah. That is deeply distressed pricing. It's pricing in regulatory panic, not operational value.
And we have to just stress the risk of a stock trading at that level. We're in extreme microcap territory here.
Yeah, absolutely. The liquidity risk is enormous. The market cap is tiny, so even small trades can cause these huge price swings. The bid-ask spreads get wide. It's just very difficult and expensive to get in or out of a position.
For most regular investors, that alone is a deal breaker.
It should be.
Now, technically speaking, when you see a collapse that sharp, over 60% in a few days, the momentum indicators must be screaming deeply oversold.
They are.
And that's a word that gets contrarian investors interested, right? They see that and think a bounce is coming.
And a technical bounce is certainly possible. The stock is stretched, no question. But the problem is that here, technical analysis runs straight into a brick wall of structural failure.
So any bounce is built on sand.
Exactly. It's totally unstable because you have this binary regulatory decision hanging over everything. You can't build momentum. It's not an investment. It's a pure bet on the outcome of that appeal.
Which shifts our focus from the charts to the catalysts. And it feels like we have a perfect storm brewing over the next 3 months.
We really do. Two main forces are at play. Number one is obviously the regulatory decision. The Nasdaq appeal outcome.
A big one.
It's everything.
Yep.
A favorable decision, letting them stay listed, that would trigger an immediate sharp rebound, a huge relief rally.
And if they lose and get moved to the OTC markets?
That will weigh heavily on the price, no matter how well the clinics are doing. The lower visibility, the lack of institutional access, it's a major blow.
Okay, that's catalyst one. What's the second?
The second is purely fundamental. It's the financial result.
The Q4 earnings?
The Q4 earnings release, yeah.
Right.
That's expected around February 10th of next year. That's their chance to prove that the Q3 cost controls and that 9.2% comp sales growth, that it wasn't a fluke, that it's sustainable.
They need to show the turnaround is real and durable.
Investors need that proof.
Now, beyond those official events, situations like this, they always attract speculators, people hunting for that massive sudden upside. What are the rumors? What are the potential rescue scenarios people are whispering about?
And this is exactly why smart contrarian money is watching this so closely. The chatter centers on a few things, but the biggest one is private equity interest.
A PE buyout. Why would a PE firm touch this with all the corporate instability?
Because they see those underlying clinics as being on sale for an incredibly cheap price.
So they look past the stock market mess.
They look right past it. The thesis would be, the clinics themselves are great assets generating healthy growth. The public corporate structure is what's destroying the value. So a PE firm could come in, buy the whole thing for pennies on the dollar.
Take it private.
Take it private, restructure the debt, clean up the governance, and unlock the real value of the clinic network without all the public market headaches.
Interesting. So they're valuing the assets, not the equity.
Exactly right. There's also speculation about a major internal debt restructuring, or maybe a big management shakeup.
A new team to signal to Nasdaq and the market that they're serious about fixing the root cause of the problem.
Precisely. And the third rumor you hear is a potential alliance or merger with a bigger veterinary network operator.
Consolidation.
It's rampant in the sector. A larger, stable player could just acquire them to absorb their healthy clinic footprint. It's a quick and easy way to grow.
And we look at the potential reward here. I mean, some of the price targets being floated if a rescue happens are just astronomical. I saw one as high as $1.82.
It's a huge number.
From 12 cents, that's monumental. But we have to put a huge asterisk on that, right?
A giant one. That $1.82 target is strictly, and I mean strictly, contingent on one of those rescue scenarios playing out.
It assumes a successful appeal and a re-rating, or more likely, a buyout premium being paid.
Right. It's a valuation of the operational cash flow, not the distressed stock. If no appeal and no rescue happens, that target is completely irrelevant.
Which brings us right back to where we started. This isn't a fundamental investment, is it? It's an event-driven speculation.
That's the only way to look at it.
So let's summarize the profile here. This is clearly for investors with a very, very high tolerance for risk.
The highest. This is a textbook binary bet. You are betting almost entirely on the Nasdaq appeal or a sudden M&A deal in the next few months.
The potential rewards are huge, based on that 9.2% clinic growth.
But the risks are existential. I mean, the governance risk is off the charts, and the ongoing losses mean liquidity is always a threat. The corporate structure needs a life raft, and it needs it now.
It really does.
Look, if Inspire Veterinary Partners can somehow navigate this appeal successfully, the value of those strong clinics and narrowing losses, it could suddenly become incredibly apparent to the market.
But if they fail?
If they fail, those same strong clinics become valuable to private hands only, likely for a very low price.
What a fascinating case study.
It really is. The core question for you to think about is, what does the market value more? Strong operations or clean governance? If those PE rumors are true, it suggests that sometimes a public listing can be the very thing that destroys value for a fundamentally healthy business.
An incredible tightrope walk to watch. A great business fighting for its life because of poor corporate management. Thank you for breaking down all the risks and the surprising bright spots.
My pleasure.
We will be watching that Nasdaq decision very closely. And if you want more expert analysis like this, make sure you subscribe to the show.